Welcome to Section 7 of the ASC 323 training series on the equity method and joint ventures. This is the final section of the course, and it is where everything becomes operational. We will walk through the 5 most common mistakes teams make when applying the equity method, what auditors expect to see, who is responsible for what across the 3-tier role structure, and how to work through the period-end checklist. Let us get started. By the end of this section, you will be able to identify and prevent the 5 most common equity method errors before they reach the financial statements. You will know exactly what auditors look for and what documentation to prepare. You will understand how responsibility flows across the 3-tier role structure, and you will be able to work through the complete period-end checklist with confidence. These are the operational skills that separate teams that get it right from teams that get findings. Let us start with the mistakes. Before we look at the specific mistakes, it is worth understanding why they happen at all. Equity method investments behave differently from ordinary equity securities, and some of the mechanics are genuinely counterintuitive. Dividends, for example, reduce the investment balance rather than flow through income. Losses stop accruing when the balance reaches zero. Many teams learn these rules in year 1 but gradually lose discipline as the investment becomes routine. The 5 mistakes we will cover are the ones that appear most frequently in audit findings and restatements. Understanding the root cause of each one is the first step to preventing it. The first and most common mistake is recording dividends as income. When a dividend arrives from the investee, the instinct is to credit dividend income, because that is how dividends work for ordinary equity securities. Under the equity method, that is wrong. A dividend from the investee is a return of capital, not income. You have already picked up your share of the investee earnings in the equity pickup entry. Receiving the dividend is just the investee distributing cash back to you, converting part of your investment balance into cash. The correct entry is debit cash, credit the investment account. If your team has been crediting income, that is an overstatement of both income and investment balance. The second mistake is failing to amortize basis differences. When you acquire an equity method investment at a price above the book value of your share of the investee net assets, that excess, the basis difference, needs to be allocated. You are essentially performing a mini purchase price allocation, identifying how much of the excess relates to depreciable assets, intangibles, inventory, or embedded goodwill. Each allocated amount then needs to be amortized over the appropriate useful life and deducted from your equity pickup each period. Teams that skip this step overstate their equity and earnings every period and accumulate an error that compounds over time. Mistake 3 is continuing to pick up losses after the investment balance hits zero. Under the equity method, you generally cannot carry the investment below zero. You cannot recognize losses on behalf of someone else beyond your exposure. When the cumulative equity and losses brings the balance to zero, you stop. You do not reverse the entry, and you do not continue accruing negative balances. Instead, you document the suspended loss amount. If the investor has guaranteed the investee debts or committed additional funding, that changes the analysis, but absent those commitments, zero is the floor. Automated journal entries are a common culprit here because they keep running unless someone actively monitors the balance. The fourth mistake is ignoring the investee other comprehensive income. Most teams focus on the investee net income line and calculate the equity pickup from there. But the equity method requires you to also pick up your proportionate share of the investee other comprehensive income items, pension liability adjustments, hedging gains and losses, and currency translation adjustments. These items bypass the income statement but still flow through your equity. If your investee has a significant pension plan or hedging program, the OCI impact can be material. The fix is straightforward. Make sure you are working from the full set of investee financial statements, not just the income statement. The fifth mistake is using the investee reported net income without eliminating unrealized intercompany profits. when the investor sells goods to the investee, or the investee sells to the investor, and those goods or assets have not yet been consumed or sold to a third party, there is an unrealized profit sitting inside the investee balance sheet. You cannot pick up your share of a profit that has not yet been earned from the perspective of the combined economic entity. The intercompany profit must be eliminated from your equity pickup. The key word is unrealized. Once the goods are sold externally or the asset is depreciated away, the elimination reverses. This requires close coordination between the teams handling the investment and those handling commercial transactions with the investee. Now let us shift to the audit perspective. When auditors review equity method investments, they are looking for documented evidence that supports every number on your balance sheet and income statement. They apply professional skepticism, meaning they will not simply accept that the calculation is right. They want to see the work papers. They want to trace numbers back to investee financial statements. They want to see that you performed the analysis required, not just that you recorded a number. There are 5 key areas where auditors focus their attention, and being prepared in each one before fieldwork begins will save significant time and prevent findings. The first audit area is the investee financial statements themselves. Auditors will want to see audited or, at minimum, reviewed financial statements of the investee for the period under audit. They will also confirm the ownership percentage using share registers, partnership agreements, or other legal documentation. If the investee statements are unaudited, you need to document your assessment of their reliability. Everything flows from these statements: the equity pickup, the OCI items, the impairment indicators, so having them complete and readily available before fieldwork begins is essential. The second audit area is the basis difference analysis. Auditors will want to see the original acquisition work paper that allocated the excess purchase price across identifiable assets, liabilities, and embedded goodwill. They will then want to see the amortization schedule for each allocated item, showing the original amount, the useful life, the annual amortization, and the remaining balance. Goodwill embedded in the investment is not separately amortized under Accounting Standards Codification 323, but it must be documented and considered in any impairment assessment. If your work papers are missing or incomplete, this is typically the highest risk area for audit findings. The third audit area is the equity pickup calculation itself. Your reconciliation should be clear and fully traceable. Start with the opening investment balance, add your share of the investee net income, deduct dividends received, deduct basis difference amortization, and arrive at the closing balance, which must tie to your general ledger. The other comprehensive income pickup should be shown separately with direct tracing to the investee OCI schedule. Auditors will verify mathematical accuracy, confirm the ownership percentage applied, and test each component against source documents. A clean, well-labeled work paper here will move the audit forward quickly. The fourth audit area is impairment. Auditors expect to see a documented other than temporary impairment assessment for every equity method investment where indicators are present. That assessment should list the indicators you evaluated, the evidence you considered, and the conclusion management reached, with a clear rationale. If the conclusion is that no impairment exists, that rationale needs to be robust enough to withstand challenge. If the conclusion is that impairment has occurred, the write-down must be recorded in the current period, and that impairment loss cannot be reversed in a subsequent period, even if fair value recovers. The fifth audit area is intercompany transactions. Prepare a complete schedule of every transaction between the investor and the investee during the period: sales of goods, asset transfers, management fees, financing arrangements. For each transaction, assess whether unrealized profits exist at period end and calculate the elimination. Show how the elimination affects your equity pickup calculation. Auditors will frequently request direct confirmations from the investee to verify that your schedule is complete. Missing transactions discovered during audit are a red flag for control deficiencies, so the completeness of this schedule matters as much as the accuracy of the calculations. Effective equity method accounting does not happen by accident. It requires a clear three-tier role structure where each level knows exactly what it is responsible for and when to escalate. The team member prepares. The team lead reviews. The manager approves. The critical design principle is that judgment-based conclusions always move up the chain. They are never resolved at the level that first encounters them, and no one reviews their own work. This structure exists not because individuals are untrustworthy, but because equity method accounting requires experienced oversight at multiple levels. The team member is responsible for the ground-level work, identifying investments, classifying them, recording transactions, and preparing the supporting schedules and reconciliations that the audit will rely on. The most important behavioral rule at this level is escalation. When a team member encounters an unusual item, a borderline classification, or a situation that requires judgment, the immediate action is to flag it to the team lead. Team members do not resolve judgment calls on their own, regardless of how confident they feel. The equity method has enough complexity that even experienced preparers can miss nuances that a reviewer would catch. The team lead is the first line of review. They review every classification, every journal entry, and every supporting work paper prepared by the team member. They also review the draft financial statement disclosures for completeness and accuracy. The team lead has deeper technical expertise and can catch errors that a preparer might miss, but the team lead also has escalation obligations. Any judgment-based conclusion, significant estimate, or disclosure that requires client communication must move up to the manager. The team lead is not the final decision-maker on matters of substance. The manager holds the final approval authority for anything that involves significant judgment. That includes whether an investment qualifies for the equity method, how to treat a complex intercompany arrangement, what to conclude on impairment, and how to draft a disclosure. The manager also serves as the interface with client management on significant accounting decisions, ensuring that the accounting conclusions are understood and agreed at the right level before the financial statements are issued. Nothing goes out without manager sign-off. The period-end checklist is your practical guide to completing equity method accounting every reporting period. The first half covers the equity pickup and investment balance. Start by obtaining the investee financial statements. Calculate your share of net income or loss. Deduct basis difference amortization. Pick up your share of OCI items. Then reconcile the investment balance from opening to closing, with every component documented and traceable. This reconciliation is the central work paper for the audit. It should tie to the general ledger and reference every supporting schedule. The second part of the checklist covers dividends, intercompany, impairment, and the zero balance test. Verify that every dividend received this period reduced the investment balance rather than flowing to income. Confirm that all intercompany transactions have been identified and that unrealized profits have been eliminated. If any impairment indicators were present, confirm that an other than temporary impairment analysis was documented and concluded. And check the investment balance. If it is at or near zero, confirm that loss recognition has stopped and that any suspended loss amount is documented. These steps prevent the 5 common mistakes we covered earlier in this section. Let us bring this final section together. The 5 common mistakes are all preventable with the right discipline. Treat dividends as a return of investment. Perform the basis difference analysis at acquisition and amortize it. Stop at zero, pick up OCI, and eliminate intercompany profits. Auditors focus on 5 areas and expect well-prepared work papers for each one. The 3-tier role structure ensures that judgment calls reach the right level of experience before they become conclusions. And the period-end checklist is your operating tool to execute all of this consistently every period. Thank you for completing this section on controls, audit, and period-end operations. You have now completed the full ASC 323 training series. Thank you for watching. Subscribe for more training from PNJ Group.